One of the things I hear a lot when I'm talking to small business owners is they look at their financials and they see a profit at the end of the month, but then they say, where is the cash? I have no idea. It says maybe I made $10,000 of profit, but I don't have $10,000 in my bank account, or at least $10,000 more than what I had before. And so this is a really common problem. If you've ever experienced this, where you see on the financials on paper, it looks like you should have money, but then when you go to your bank account, there's no money there. So if that is you, this is the video for you. And I'm going to explain and actually show you a real set of financial statements so you can see a good example of what might be happening in your business as well. So if you don't know me, my name is Hannah Smolinski, and I run a fractional CFO company called Clara CFO Group. And this channel is really dedicated to helping small business owners, specifically service-based small business owners, understand their financials better so ultimately they can have more financial success. So if that's you, make sure you're subscribed to the channel. Okay, so the first thing I need to address is that there's two main ways you can look at your financial statements. That is on a cash basis or an accrual basis. So cash basis financials mean that you record income when cash comes in the door. So you send an invoice, and once that invoice is paid, that's when you record your income. And the same with your expenses. You might receive a bill, but you don't actually record that expense until you pay that bill. Now, on the reverse of that is the accrual method. And that's going to be you record income when it is earned. So maybe, and there's lots of different definitions of how things get earned, but typically it's when, if you're a service business, when that service is provided, then you record it as income, whether or not you've actually been paid by your customer, okay? Now, similarly, on the expense side, if you receive a bill, that means that that has been incurred, that expense has been incurred, and you're supposed to record it in that period when it's actually incurred, not necessarily when that bill is paid, okay? So there's a lot of discrepancies between profit on the accrual side and cash. So you can show a huge profit, an accrual situation, but you might not have received any cash because maybe you sent out an invoice for $1 million and technically you've earned that $1 million, but that cash has not been paid yet. So you might actually be in a cash strapped situation. Okay. So if that's the case, that's accrual. You are going to have lots of discrepancies between your profit number and the cash coming in the door. But what I see more often is most small business owners are run on a cash basis. So who I want to specifically talk to in this video are those people who are running their businesses on a cash basis. Because in your mind, you might be thinking, well, I'm running on cash. It should be cash in, cash out equals cash left over, right? If I'm looking at my profit and loss statement, that's what I should be seeing. So if I, see a profit of $10,000, where is that $10,000? I want to see my bank account increasing by $10,000. So that is the logic of most small business owners, which makes sense. Cash basis, cash in minus cash out equals cash left over. But there are other things that you are doing in your business that can decrease your cash balances, and you can still show a profit on your profit and loss. Okay, so that's what I want to show you today. And I'm going to pop into a set of financials in just a minute, but I'm going to basically tell you there's going to be a few culprits here that are going to show up and be the difference between your profit number and your actual cash number. Okay, now, those culprits, if you will, and I'm not saying they're necessarily bad, I just think we need to know what those things are so you can be aware of them. They're going to be things that are going to show up on the balance sheet. So if you've never read your balance sheet before and you're not familiar with your balance sheet, this might be one reason you have that disconnect between the profit number and your cash number, okay? But we have the things called balance sheet transactions. So these are things that show up in the differences in your assets, the differences in your liabilities, and your equity section of your balance sheet. They're going to be affecting your cash. So some really common ones are going to be debt payments. So let's say you were paying off a credit card, and let's say that your credit card balance was $10,000 and then you put $5,000 towards it. That credit card balance, that payment that you made of $5,000 does not show up on your profit and loss. that is a balance sheet transaction. So that means cash is going out the door, but it's not affecting your expenses on your profit and loss, okay? I'm gonna show you this. I'm gonna explain it, and then I'm gonna actually show it to you so we can bring it all home, okay? So balance sheet transactions like debt payments, that's gonna be one of the big ones that are going to affect your cash balances. Another really big one is going to be the timing of when you record income versus when it actually hits the bank. So this happens in QuickBooks really often, where let's say a customer, you sent an invoice through QuickBooks and a customer paid your invoice on December 31st, okay? Now QuickBooks is going to record it because they paid it on December 31st, but there's a float time between when the invoice is paid in QuickBooks and they're recording it as cash, even though you don't have the cash yet in your bank account. So there's going to be a timing delay between when QuickBooks records your income versus when that cash actually hits your bank account. Okay, so that does happen fairly often. Like we just had that happen in our CFO business. We had a customer pay their invoice on December 31st, but we didn't see that money actually hit our bank account until January 5th or so. Maybe it was January 3rd. I don't really remember, but it took a couple days for that money to come in. And that's really normal to, through electronic payment processing, right? So those two things are going to potentially affect your profit compared to your cash. Now, the other really important one is going to be your owner's draws, okay? Now, owner's draws is when you take money out of the business to pay yourself for compensation for doing the work that you would do in your business, or it's just a profit distribution. You can also take owner's draws to pay your taxes, okay? So the example that I'm going to give today, the owner took some money for taxes and some money for just compensation, and that affected the overall cash balance, okay? Now, when we take owner's distributions out of our business, that is a balance sheet transaction, and that shows up in the equity portion of the balance sheet, okay? So those three things I mentioned are gonna be the main fluctuations between what your profit number is showing and then what your cash balance is. So that could be the timing of your income, and versus like what your accounting system records versus when the cash actually hits the bank. It's going to be debt payments, and then it's going to be owner's draws for either compensation or for taxes, okay? So let's go ahead. I'm gonna show you, I've got a profit and loss, I've got a balance sheet, and I've got a statement of cash flows. So we can look at all three of those for this real business and this exact situation where cash actually went down in the period, even though there was a substantial profit. So I'm going to show you that. Let's hop in. Okay, so here we are in a profit and loss statement, and this is for we're going to call this a consulting company. Okay, so these are actually real financial transactions that I've just changed the name of the business and some of the accounts so that I can show you guys like this is a real month of business, and it's not giving away anything confidential. So in this situation, this business made about $20,000 or $20,700 in income. They had minimal expenses, about $3,000 expenses. So profit was $17,619. Okay, so this is a pretty high profit margin business. And so this is a cash basis business as well. So cash was received about $21,000 minus the $3,000 to end up with 17.5. Okay, now if we were just on cash basis, we would be thinking, well, cash should increase by $17,000. But let's look at the balance sheet and see what happens. So we're looking at the month of April, and then let's look at the balance sheet. So when we're looking at the balance sheet, I always like to compare the balance sheet to the previous month, because this is where we can see how the cash has moved from last month to this month. So you'll see in this column is the April results, and then in this column is March results, okay? So $24,859 is the cash balance as of the end of April. Now compare that to the previous month of $25,923. So that's actually a loss, a decrease in cash of about $1,000, okay? So this is where we're going, wait a second, I made $17,000, but why hasn't my cash balance gone up? Okay, so this is what has happened. So remember what we talked about. We talked about the timing of income. We talked about debt payments, and we talked about equity transactions where the owner was paying themselves an owner's compensation. So in this situation, there wasn't any issue with the timing of invoices. And actually, we wouldn't be able to really tell that just by looking at financial statements. We'd have to go into the accounting system and see if that was affecting it. But I happen to know that that was not anything that was affected in this situation. So we're going to go now down to liabilities, because maybe there's something happening with the payment of our liabilities. And what we'll find is that that actually is the case. So at the end of March 31st, the debt balances were $11,000, and then that decreased to $7,444. So we had a decrease in liabilities of $3,653, okay? So when we decrease liabilities, how do we decrease a liability? We pay it off with cash, okay? So with the credit card, we made extra payments to the credit card, and that decreased the balance of what we owe to the credit card company, okay? So this is part of where our cash went. Part of the $17,000 we earned in profit went to paying down this credit card bill. Now, we're going to go down into equity now and say, okay, well, that takes care of part of it. That's where part of the money went, because remember, we actually, are down $1,000 in cash. We're trying to figure out where the rest of the money went. So then we find the other piece, which is the owner distribution line. As of March 31st, the owner had taken a little over $23,000, but as of April 30th, the owner had taken out $38,670, okay? So that is a $15,000 difference, and this is the bulk of where the money went during the period, okay? So this is the big thing. So when I dug into this a little bit more, the owner had done two things. They took a $5,000 distribution for compensation, and then they made a $10,000 tax payment. So this is in the month of April. So there was a estimated tax payment due as of April 15th. And so they made that tax payment, and that is why this owner's distribution amount is higher. Okay. So that is, between the debt reduction and this $15,000 payment, that's a little over $18,000. And that's why we are actually decreasing the amount of cash even more so than the profit that we made. So all this comes together in the statement of cash flows. So I'm going to show you this as well. So another way to look at your cash flow and where it's gone during a period is by using the statement of cash flows. Now, we don't always show the statement of cash flows when we are talking to clients, because we have other ways of looking at the cash flow and where the money has gone. But I did want to show it to you just so you have kind of a comprehensive understanding of what this statement is about. So when you pull a statement of cash flows in QuickBooks Online, it's going to default to an accrual basis net income approach. And so, for example, you'll see that this does not match the $17,000 of profit we were talking about before, but this is the accrual profit. So I did pull a profit and loss just to show you that. And here's the accrual basis profit and loss, and the net income is basically $20,000. So the difference is that this is actually including the change in accounts receivable when looking at the total cash flow. So with this, you start with net income, and then you say, what are the adjustments to net income to talk about where the cash has been moving and what they call operating activities. So changes in assets, changes in liabilities are going to show up here. So when I say changes in liabilities, that's what we talked about with making payments to the credit cards. So that decreases the cash. And then actually what also decreases the cash from net income is when accounts receivable increases, because it's saying basically, yes, you recorded that income for accounts receivable, but you didn't actually get the cash. So that's what creates the increase there. And then down in financing activities, it shows where we took that owner's distribution. So it's kind of reconciling the cash back to net income is essentially what the statement of cash flows is. So I just wanted to show you that real quick, because sometimes it's helpful, because the statement of cash flows sort of is where you can go if you are very confused about what is the difference between my net income and the cash that's on hand. This is going to point you in the right direction of where you need to look. And all of these things that we're talking about are those balance sheet transactions, stuff that's happening on the balance sheet that is not happening on the profit and loss. So hopefully that clears things up, or at least it helps you understand where you need to look to find the difference between your profit that is recorded on your P&L and your cash in your bank accounts, okay? So if this video has been helpful, please make sure that you give it a thumbs up and that you share it with another small business owner who might also be a little bit curious about how to understand their financials a little bit better. And make sure that you put any questions in the comment section below, because I take a look at all of those comments. All right, well, thank you so much for being here, and we'll see you in the next video.